All right, so we just had a discussion looking at what happens when market interest rates fall, okay? Now what we're looking at here is we're thinking about what happens when market rates rise, okay? So we're starting off with this example up here where we have a par value of $1,000. We have a 10% coupon rate. Coupon rate, that's the amount of interest payments paid to the investor, right? So it has a payment of $100. We have a discount rate of 10%, right? So our discount rate, R equals I. Our discount rate, the market rate, all right? That's when we talk about the discount rate here. That's what is required for the investor, right? That is the discount rate, and that's the market rate, because my company is going to have very, very similar risk tolerances to other companies out there, right? And at 10 years, okay, so the bond is going to trade for $1,000. It's going to trade at par value, okay? Now, if interest rates, right, so we then hold on to this bond, we wait another year, and let's say that interest rates rise, okay? The market interest rates rise. So that means that R is going to increase, and let's say it goes up to 12%, okay? What is going to happen to the value of this bond? Think about it for a second. Is this bond now more valuable or less valuable? Okay. Now, let's walk this through. Okay. We have a bond. It is paying out $100. Okay. If I were to issue another bond today, right now, at $1,000 par value, okay, at $1,000, and I want to get and I'm going to issue it at market rates at 12%. How much is my payment going to be? My payment is going to be $120. Okay. You as an investor, would you rather receive payments of $100 or of $120? Right. The $120 is what you would rather have more than the $100. Okay. So this one that's paying you more, and this is for the same level of risk. Keep in mind, same exact level of risk. Okay. Same company. Nothing in the company itself has changed. The only thing that has changed is that interest rates have risen, okay? So now that you are getting paid $120 versus the $100, do you think this is worth more? Yes. You'd rather have the one that's paying the $120, okay? So if interest rates rise, okay, and we issue this bond at 12%, right? We have a payment here of $120. That also means that R is going to be what? R is going to be 12. So what is this bond going to trade at? This bond is going to trade at, have a present value of $1,000. Okay? This is a newly issued. Okay? And the one up top is a 1-year-old bond. Okay? So if I can sell this bond, this new bond at 12% for $1,000, what am I going to have to do in order to sell that first bond that's only paying $100 a month? Okay. I am actually going to have to discount it, right? This is last year's merchandise. I got to clear it out, right? Same thing that's going on with these other places. The thing that's going to change here is that we're going to change this R equals 12%. Okay, and then we can solve it through, and the way we're going to set it up, right, is that we're going to have 1 minus 1 over 1.12 to the, well, I guess there's 9 years left now because it's a 1-year-old bond. Okay, and that is divided by 0.12 multiplied by our payment out here, which is $100 plus, right? Setting up our annuity portion and the lump sum portion. And then when we plug this in here, is that we're going to see that the present value is now less than $1,000. Okay? It's pretty straightforward here, guys. So when we have, and this is the important thing we have to look at, we have to look at this from the investor's perspective. When the investor is not making as much money, they want to sell it for less, right? There is an emotion involved in these bonds. It is just how much money am I going to make, right? It is a singular sole focus, right? It's not like our own personal preferences when we walk into the grocery store, okay? All right. Well, I hope that clarifies things on what happens when the market interest rate changes. But there are some other things that can happen when the market changes as well. And we'll be going into those here next.